Barb Carey, and I'm a member of the Environmental Action Team. We just heard a really inspiring service about hope and action in changing the world with our love, and investing our finances to benefit the world is one form of action that can help bring more hope and love into the world. So we're very pleased to have Longwave Financial with us today. Longwave is a New York-based financial advisory firm that helps clients, including faith-based organizations, to pursue their financial and values-based goals. Longwave started out as a traditional financial advisory firm, and a collective voice within Longwave's client community expressed an interest in aligning their money with their values. So Longwave began to explore building portfolios that adhere to conventional investment principles, but also doing good in the world. So through years of research and due diligence, the company has found it possible to achieve both. Longwave's mission is to use their time and resources to ensure the health of their clients' financial futures, while also making the world a better place for generations to come. We're very happy to have Brennan Ramos and Brandon Wester of Longwave here on Zoom today to explain how it's possible to do have both financial health and making the world a better place. Brennan and Brandon, take it away.
Thank you so much, Barb, and thank you everybody for joining us today. It's great to be here with you all, and special thanks to the Environmental Action Team for graciously inviting us to speak with you all today. My name is Brennan Ramos. I'm a financial advisor at Longwave, and I'm joined by my colleague and Director of Investment Research, Brandon Wester. Every day we make conscious efforts to live our lives in accordance with our values. As consumers, we choose the businesses and brands to buy from. As donors and givers, we choose the organizations and the causes that are important to us to donate to. And many of us as environmentalists make concerted efforts to reduce our carbon footprints to ensure a sustainable future for our planet. But an often overlooked avenue to impact is through investing. And there are very valid reasons for that. Perhaps we find it difficult to navigate the complexities of the stock market. Perhaps it's a matter of risk and skepticism and not willing to compromise the hard-earned savings that we've all accumulated. Or perhaps it's just a lack of general understanding, not having a sense of direction as to where to start. So we're going to talk about that today. We're going to share a little bit about the history and background of values-based investing and how it's evolved over the years. We're going to try to debunk and demystify a lot of the myths and the misconceptions that exist about values-based investing, how we think about it at Longwave and applying our own philosophy to values-based investing. And finally, we'd love to share our own observations from the UU's Common Endowment Fund and try to answer the question as to whether it is truly reflective of your own values. We've allotted some space for Q&A, so I would just please ask that you hold your questions for that space at the end. And if any other questions come to mind that you'd wish to either ask privately or after the presentation, we'll supply our contact information with the Environmental Action Team, and we'd be happy to answer any questions that you might have. Values-based investing was not an overnight phenomenon. And as a matter of fact, the origins of values-based investing can be traced back decades ago, going back to the 1960s, focusing specifically on industries and certain countries to exclude from portfolios, for example, the country of South Africa during the apartheid regime. Over time, values-based investing has evolved into a holistic framework for investing to encompass a solution to sustainable and ethical considerations in portfolios. But really at the crux of values-based investing, which has evolved today into an acronym known as ESG, or environmental, social, and corporate governance considerations, is an ideological debate between two schools of thought. And those two schools of thought are shareholder capitalism versus stakeholder capitalism. Traditionally, capitalism has been synonymous with maximizing shareholder value. That is, corporations exist for the sole purpose of generating value for its shareholders and nothing else. ESG challenges this norm by embracing a new model of stakeholder capitalism, which recognizes that corporations exist not only to generate value for its shareholders, but are also intertwined with other considerations like the environment, the well-being of its employees, and society at large and beyond. Ultimately, what we're seeing today is a paradigm shift from generating short-term profits to a much longer-term sustainable value creation for all these other stakeholders that have vested interests in the operations of corporations today. And, the question is, why does that matter? ESG transcends profit margins. It's about creating a world where companies not only deliver shareholder returns, but also are considerate of the impacts that they have towards the environment, towards its employees, and towards the communities to which they operate in. I'm going to pass it along to Brandon to explain a little bit more about the spectrum of investing that exists out there today.
Yeah, so starting kind of without any ESG considerations, just traditional investment, there's kind of a couple paths you can take. Most people are probably very familiar with passive or indexed investing, which is just purchasing every company out there and holding it according to their market weight. This is what a lot of Vanguard does. Vanguard releases a lot of index funds. They're very popular. They're one of the largest money managers in the world. BlackRock does the same thing. And they generally will attempt to vote those shares on behalf of the investors in a pretty neutral way, or attempt to. And that can lead to problems when there's environmental or social considerations surrounding those proxy votes. And then you can take more of an active approach too. There's a lot of active management that's been shrinking over the years, but been pretty popular throughout the history. It used to be the only option really prior to the 1960s, and when we started tracking indexes pretty heavily. And active is thinking that you can beat the overall stock market. You can make outsized bets on certain industries or certain companies in an attempt to beat the overall market and the returns each year. Sorry, I can speak up a little bit. One thing that history has kind of shown, research has shown, is that active management has not been competitive to indexed management or passive investing for quite a while. And a lot of that has to do with fees. Investing in an active way costs substantially more than just investing in a passive index where there's not a bunch of analysis and trading going on. Analysis and trading costs a lot of money and almost completely negates all additional returns you would get from an active management style. So that kind of lays out the two different paths you can take from a traditional investing standpoint. And then how ESG investing kind of started originally was in how most ESG dollars are invested, values-based dollars are invested, is kind of in this reduce harm arena. And what that really means is exclusionary. So you will take an entire index, you will take the United States and all their companies, and you will remove what you do not want. And that's how you would invest. So you remove the oil industry. So you will own the index, but not oil. And that is an exclusionary approach. It is very popular, but can skew you away from the index and also cost more because you need to do analytics. It's somewhat active in its very nature. And it leaves a little bit of room on the table to do better from an ESG standpoint. From our perspective, we think that you can take it a step further and actually engage instead of just putting your head in the sand and ignoring the evil or the bad or anything that's going on in the world. You can actually actively engage to make it a better place and make sure companies are operating in more accordance with the values that we support. And that's where impact investing comes in, which is a newer concept and where ESG has kind of been moving in the past couple years. And what that focuses on is more leaning into engagement with the ownership of these companies. So instead of just ignoring the oil industry completely, a good example of this is a company called Engine Number One. They started and invested a bunch of money in Exxon and got to put people on the board of Exxon and changed a lot of their practices. Gave them a net zero carbon target and a few other things to invest in green technologies and dump a lot of capital in expanding that part of the industry. And so instead of just ignoring Exxon, not purchasing it, letting them continue to do what they did, what they do is to actively engage and attempt to change the company from the inside through outsized ownership, owning and then speaking up. So those are a couple different takes in the ESG space. There is a purpose for both of them. There's areas where exclusionary based ESG investing is more beneficial for your dollars. And then there's areas where impact is more beneficial for your dollars. It's all about being intentional and allocating capital appropriately so that we can have results like an index manager, but have our values aligned in the most appropriate way possible, where our capital is going the furthest. And you do that by utilizing both exclusionary and impact-oriented strategies.
Thanks, Brandon. Unfortunately, over the past few years, as ESG investing has grown in popularity, so have the critics. And recently, ESG has been caught in the crosshairs of political discourse, and pundits have argued that this style of investing and this philosophy means that you have to give up returns and you take on too much risk. The fees you pay are too high, and other adverse claims that aren't necessarily true to what we have found and what a lot of the research and data supports. As a matter of fact, numerous studies that we have seen through large research institutions have shown that ESG investing not only has the potential to match traditional investing styles, but also has the potential to outperform those styles as well. Companies with diverse boards of directors, for example, and women-led organizations, for example, a study from McKinsey, which is one of the largest consulting companies in the US, showed that the stock prices of those two types of corporate board structures have outperformed those without. Another common misconception amongst ESG investing is that the funds come with high fees. And we are here to tell you that it's simply not the case. Today, as the industry has evolved, there are now hundreds of low-cost index funds and ETFs and even mutual funds that have competitive fee structures within the rest of the industry as a whole. Some argue that ESG investing limits your investment choices to either invest in environmental considerations social considerations, corporate governance considerations, and that's it. But that's not the case either. And as a matter of fact, ESG investing today spans across various industries and sectors and asset classes to provide a very broad range of choices in order to construct a diversified portfolio. Moreover, there is a growing number of availability of metrics and reporting standards that make the measurement of social and environmental impact effective today. And we'll share some of the tools that we use at Longwave in a moment, as well as resources that you can also explore for your own portfolios to take a look under the hood. Something that Brandon always tells us at Longwave, and he's very vocal about it, and if there's anything from this segment of the presentation that we'd love for you to take home, is that ESG portfolios underperform for the same reasons that non-ESG portfolios underperform. It's a lack of diversification. It's high fees. It's too much risk. It's not controlling for taxes. All of these things as investors, we can control. And through applying these very fundamental, very conventional investment principles to an ESG or values aligned portfolio, you can achieve both of those things together. And we'll share a little bit more about how we at Longwave have applied this philosophy to the ways that we construct our portfolios.
Yeah, so this chart kind of shows our process a bit on how we tackle creating ESG-oriented portfolios at Longwave. And it's pretty fundamental in nature. This is how you would create just about any portfolio, but with a couple added steps. You take the entire investment universe, every company, every bond, every investable asset in the world, and you filter that through screening. That's the additional process, the ESG process. We use partners like Sustainalytics, Your Stake, the Sustainable Investment Forum, and As You Sow. You may have heard of a couple of these. As You Sow seems to be pretty popular, name recognition wise, but these are all very competent data sources for ESG information. And we screen all assets through these tools, figure out what we can and what we can't invest in to meet our objectives from an ESG standpoint. And then we apply our philosophies, as Brennan mentioned, diversification. We attempt to have high correlation to our index, so we avoid some of that underperformance. We focus on low fees. Here, let me see if I get rid of, you might be able to hear me better if I disconnect. Let's see if you get, can you guys hear me a little bit better now, maybe? All right, great. So now that we've screened out all of the poor investment choices from an ESG standpoint, we take an approach where we apply the Longwave philosophies that Brennan mentioned: diversification, high correlation to our benchmark, so we avoid some of that underperformance. We focus on low cost funds, highly tax efficient funds, and overall we want to provide an experience from a risk and return standpoint that is very similar to what you would get if you were investing without ESG principles, but you are getting as rigorous ESG kind of principles as you would if you were in an active portfolio. So trying to have best of both worlds here. And then lastly, once we have some portfolios that we like, we run them through a bunch of different analytical metrics, risk and return. We extrapolate into the future, see any potential risks. We back test to see how they would have done, and take all that information into deciding what these portfolios are, which one we're going to select in the end, essentially.
Thanks, Brandon. And we wanted to give you a sense of how this looks in practice. By our rules of compliance, we can't publicly illustrate our performance data for our portfolios. However, we can share some of the outcomes and exposure and many of the ESG factors that we track in our portfolios. And I'll mention with some of the tools that Brandon explained, Your Stake, Sustainalytics, these providers are also used by the investment team, by your endowment. So it's likely that they're screening for much of the same factors as we do. So we'll give you a sense of how we apply this in real life. So some of our portfolios, for example, we've made it so we have 100% less fossil fuel company exposure versus a normal index that includes all companies out there, 82% less exposure to companies that are involved in toxic water pollution, 89% less exposure to businesses that are involved in unconventional weapons manufacturing, as well as 100% more exposure to companies that adhere to political transparency voting support. Now, the question that comes to mind often is that why isn't this all zero? Why can't I exclude all of these things out from my portfolio? And how come the data doesn't show 100% less exposure to all these different factors that we track? There is some nuance to the data, and it's not a perfect science. So, for example, what you might see is we can exclude all of the stocks of private prisons in the United States. And this is also a screening done by the UU's Common Endowment Fund. But let's say, for example, a portfolio owns a company like Coca-Cola. Well, Coca-Cola might generate revenue from vending machines in those facilities, which will show up in some of these data screens. And I imagine the folks at the Common Endowment Fund are also juggling some of these nuances in the data. So we just wanted to point that out for you. And again, this is not an exhaustive list of exposures. The data providers today have become so robust that there are hundreds of different factors that you as investors can screen out in accordance to your values. So fossil fuels and fossil financing companies, weapons manufacturers, you can screen for gender diversity on corporate boards, and many others. So it's quite robust how the industry has evolved just over the past 5 years. It's incredibly exciting to us. We wanted to turn our attention now to something that is a little bit closer to home to all of you, which is our thoughts and observations on the UU Common Endowment Fund, and help you all answer the question as to whether the endowment is truly reflective of your values. I know there's been a lot of discussion within the congregation and a call to action for divesting from fossil fuels, and we'll share some of that progress with you today, as well as a few other observations. I can share candidly that through the research Brandon and I have been doing for the past several months now, ever since we've engaged with the environmental action team at your congregation, the framework that the endowment utilizes is quite robust when it comes to values-based investing. There are a number of resources online at the website, which I would encourage everyone here to check out. There are portfolio performance reports, data on the underlying holdings and the exact companies that the endowment owns. There's commentary. It's incredibly transparent. which is quite welcoming for us as investors to see that sort of transparency, especially because at the end of the day, the common fund is acting as fiduciaries, and they have an obligation to act in all of your best interests and be transparent with the way that they communicate to all of you. So wanted to first share how the fund applies their socially responsible principles through the way they manage the fund, share some updates on the progress that has been made over the past few years, and of course, share a few opportunities on what we feel might be areas of for improvement. So there are essentially 4 pillars for how the Common Endowment Fund reflects the UU values in its portfolio. And we'll walk through all of these. First, at the end of the day, structural and strategic business decisions are made in the corporate boardroom. Board members, on behalf of shareholders, advocate for what they feel is important to shareholders, and being able to voice their concerns. And shareholders have a real ability to influence corporate decision making if there is enough of a collective voice and demand for change. So that is why starting with shareholder advocacy is an incredibly important tool to have in your endowment's ESG investing framework. This involves actively engaging with companies to make positive change. And for the UU specifically, they are a part of an organization called the Interfaith Center of Corporate Responsibility, which essentially leverages a collective voice amongst like-minded faith organizations across the country to advocate for sustainable practices, ethical corporate governance, and transparency with board decision-making. And I'll share an example of this from the September update that was published. Proxy voting is another critical aspect of the endowment's ESG strategy. Proxy voting allows shareholders to vote on key issues during shareholder meetings that happen throughout the year. Again, having a voice at the table to influence board members to make the right decisions. For you all specifically, the UU Common Endowment Fund does publish all of their proxy voting online through the website. So I would encourage you, if you're curious, to take a look into the various matters for which it engages. What we have found through our research is that the endowment engages frequency on environmental as well as social issues with the companies that it invests in. Community investing is a really impactful part of the UU's Common Endowment Fund. The fund itself directs a percentage of the overall fund towards community investing. And this can involve projects like supporting community development, affordable housing initiatives, as well as sustainable infrastructure projects. And doing this effectively can lead to a really nice balance between financial returns as well as impact in the community. And I'll share an anecdote of one of the recent community investments the UUCEF made earlier this year. And then finally, as Brandon touched on earlier, investment screening is a way to carefully select investments in a portfolio based on very specific criteria. And there are plenty of vehicles and mechanisms for doing so, again, using some of the data tools that we referenced earlier. And specifically for the Common Endowment Fund, there is a list that is published of prohibited investments, again, that you can find online, for which they screen out. And these include alcohol and tobacco companies, private prisons, weapons manufacturers, and most recently, as of the spring of this year, fossil fuel companies. So with that, I did want to share a few highlights from an update from the endowment as of September. And again, all of this is published on the website, so you can check it out in more detail for yourselves. But a few areas that are really encouraging to see. Number one is the fund added fossil fuel companies to its permanently prohibited investment list as of this spring, and divested from traditional fossil fuel companies. They've also engaged with their portfolio bank holdings, specifically the New York Community Bank Corp is one of the stocks it owns. They engaged with the company's board on developing reporting standards for political lobbying, as well as discourse that's related to climate with the operations of the parent company, New York Community Bank Corp. Again, that's a really good example of that first pillar of engagement, which is shareholder advocacy through the fund. Moreover, they've exited 2 positions in the portfolio, GQG Capital, as well as RB investment managers, meaning that the common endowment fund will allocate a certain amount of money for RBC and for GQG to manage. They choose the stocks for which they invest in. And it seems that after a careful analysis of the underlying holdings of those funds, as well as RBC, which stands for the Royal Bank of Canada, they provided financing to the fossil fuel industry. The decision was made to exit both of those investment managers. And then lastly, as I alluded to, I thought a really nice point from the update was the commitment to increase the endowment's community investments from 1% of the total portfolio to 5%. And recently, they've made a $2 million commitment to an organization called OUUC, which is an organization that directs funds to indigenous communities impacted by oil and gas extraction projects around the country. Lastly, we wanted to just share our thoughts from our point of view on some areas of how the fund and the endowment could be doing better in some of these areas. So Brandon, I'll pass it along to you to share a few thoughts on these points.
Yeah, so after taking a pretty good look at the overall endowment, the underlying holdings, I previously worked a little bit on the endowment over at Notre Dame, sleeve of that, and so I have some experience in portfolio management in this realm. It's a faith-based institution as well, and we had certain screens that we needed to meet similar to the UU. And a couple areas I saw that maybe there could be more advocacy for, where there could be improvement, is one is we saw that they went ahead and divested from utilizing fund managers such as RBC. So these are fund managers that are actively potentially doing harm, but the rest of their providers are also not necessarily value aligned. They may be neutral, they may not be actively doing harm, but these are not fund providers that are mutual companies or nonprofits, or actively directing some of that expense ratio they collect towards broader issues, supporting the efforts of their underlying funds. And that's something that we take at Longwave pretty seriously, is any fund provider that we are going to consider utilizing, not only does the underlying fund have to be appropriate to be in our portfolio, but the overall fund company that is providing it must also be aligned with those values and direct their own capital towards pushing for a better planet, society, and governance. So that's pretty important to us, and they seem to be pretty neutral in that regard. Another area which is a bit different to how we managed it in Notre Dame and how we manage at Longwave and many other institutions manage is that the private investment side, which is where a lot of these community investments are, this is where they have more of an impact focus. It's pretty low for an endowment of this size. So most endowments, the common endowment model that was kind of pioneered by Yale actually, and their endowment has a much higher percentage, double if not triple to what the UU is doing in private investments. And the money in private, and the reason for that is because endowments don't need a lot of liquidity all the time. They can lock up a percentage of their capital because they are perpetual entities. It's not like a person that is going to retire and need to cash out. This entity is going to outlive, hopefully outlive all of its members. Therefore, they can lock up capital, give up liquidity for higher returns and more community impact in the long run. And so that's kind of a difference that I see between this endowment and other ones of its size, is that it's very low in private investments. And in the private investment space, you have more capacity for impact, more capacity for doing good because you are directly placing dollars into the hands of people that are making a difference. Whereas in the public markets, stocks and bonds, you don't have a direct impact necessarily on what is being done. Divesting from Exxon doesn't mean you're taking money away from Exxon necessarily. You may impact their share price if there's enough movement, enough dollars liquidated, but it doesn't have the direct impact that you can achieve through direct private placements. Lastly, is some of the engagement on governance issues. It seems to be somewhat overlooked overall. There seems to be a very heavy focus on the environmental aspect. But ESG is 3 pillars. It's not just on environmental, it's also social and governance. Governance plays a very important role and is a third of the entire framework. It seems to be underrepresented in the overall UU engagement profile. So those are some of the areas where we could see improvements being made in the endowment, and it may have a multitude of returns. Increasing private investments, lowering liquidity could potentially increase returns, not necessarily. Private investments historically have done very well, but obviously it's no guarantee. But it would allow you to improve how traceable your dollars are. That is for sure, and the impact it is having. And yeah, overall, those are really the 3 areas I would focus on if I were to do further engagement with the EU.
Right. So thank you everybody for listening. At this time, we would like to open it up to any questions that you might have. Again, if anyone has a question that they'd like to either ask privately or after the seminar is over, you can get our contact information, and we'd be happy to answer any questions that you might have. As we alluded to at the beginning of this presentation, we're based out of New York, but we are part of a growing network of ESG-oriented financial advisors across the country. And if anyone has any questions about their own specific situation or ways that they can be implementing some of these things in their personal lives, we'd be happy to direct you to local advisors who we know and who are doing this as well. So thank you.
Yeah, I see a question popped up right away that is kind of a just follow up from what I was talking about. First, to define governance. Governance is basically the leadership within a company. So some governance considerations would be board diversification. Governance could also be median pay at a company, differential between executive and CEO pay, and average worker pay. It could be employee kind of environment and their overall experience. Governance is all about how the company is ran by leadership and are they making decisions that aren't just maximizing shareholder value, so just the owners, but all stakeholders, everyone who is participating in that company, from the buyers to the employers to the local community. And the follow-up from that is private investment sounds riskier than some sounds riskier. And can you explain why that isn't so? I wouldn't say that it's not riskier. Private investments do tend to be riskier than public investments. Not always the case. There are private equity. Private equity is a form of private investment, but private investment spans a wide gambit of risk profiles. You can have private investments that are very, very safe, and then you can have private investments that are extremely risky, same as you get in the public markets. The only difference about private investments is that they are not priced on an exchange, they're not priced publicly, and so they have lower volatility and lower, they appear to have lower volatility, which isn't necessarily the case. Private investments are usually locked up for much longer. Public investment, you can go to any exchange and sell within a couple days usually. But a private investment, you need to wait years potentially to cash out. And what you generally get for exchanging that liquidity is higher returns, hopefully. So private investments can be substantially riskier, but yield higher returns. But that's not always the case. Like I said, you can get low risk investments in that space as well. And generally, private investments are only for really, really high minimum investment amounts. So if you are investing a couple $1,000,000, you will not have access to many private investments or competitive private investments. But given the UU is north of $250 million, they have access to a lot of competitive private investment options. And there is a correlation between higher amounts of capital and better access to private investments that yield better results. That has existed historically. So you would get a pretty good choice of investments from an endowment that size.
I saw a question from Janine. Brandon, I'll pass this one to you as well, and I'll offer some thoughts. Janine asked, what are some of the best screened funds for the restricted ESG considerations as well as returns? I'm inclined towards Green Century due to its nonprofit status, but I haven't done other research recently. Yes, Green Century is a great company. We're big fans of them. Brandon can share a few of the fund companies that we're fond of at Longwave. One that I'll highlight is Calvert. Calvert is a pioneer in ESG investing going decades back. They offer some of the most extensive and lowest cost index funds out there in the industry. They've done tremendous work over the past few years in getting their fees as low as possible to compete with other non-ESG funds in the industry, which was a real big catalyst for fee compression in general, which is a very welcome thing in our industry. And the other thing that I'll mention is there are lots of online resources that you can check out to screen out some of these funds yourself. As we mentioned earlier, the U.S. Sustainable Investment Forum, or USSIF, has a page of companies that do what they say they do. As You Sow is another company that allows you to take a look under the hood of funds and see exactly what stocks that they own. Unfortunately, with the rise in interest of ESG investing over the years, there has been an uptick in greenwashing and using ESG as a marketing engine. So we've seen it time and time again. We'll have a big corporate institution like JP Morgan or Goldman Sachs or BlackRock. They will essentially take a fund that might be a technology fund, right? Technology companies tend to have asset light businesses, they have lower carbon footprints than industrial companies. They'll take a technology fund and they'll relabel it as an ESG fund because of those characteristics. Meanwhile, if you take a look under the hood, they're still owning the companies that we as investors don't want to. So it does take a bit of probing and research and using some of these tools or engaging with an advisor who does this work for you. But there are many out there to choose from. And Brandon, please feel free to share any thoughts to add on to that.
Yeah, Green Century has done a pretty good job. They've been a bit innovative and they take the process of ESG investing very seriously. We at Longwave have not used them that extensively. One of our screenings is low fees, and Green Century tends to be at the very highest end of the fee structure, which can run into problems if you're looking for competitive performance over the long run. They take a very active approach. We broke down index versus active. They take generally a very active approach. That's part of their philosophy. And then they take, which costs a lot of fees. And so we tend to not align as much with that fundamental investment approach. We agree with their screening from an ESG perspective completely. We think that they are very rigorous. But that's why we use providers more like Calvert. Boston Trust has been really great. Boston Trust has been around since the origin of investing in this way. They actually advised Calvert on the very first ESG-oriented fund that was created. So Calvert and Boston Trust came together to create that first one, originally called Domini. That name resonates with anyone. But yeah, those are two of our favorite providers. Another one is Brown Advisory. They have some pretty competitive funds that do really well. I put in the chat here a link to the USIF mutual fund and ETF page that shows every fund on there has been screened by the Sustainable Investment Forum for being competitive funds. So any funds that we mentioned are going to be in there, plus a lot more. You will see Green Century in there. You'll see a lot of Calvert. You'll see Boston Trust. You'll see Brown Advisory. And there's a lot more. Parnassus, Impacts. So if you don't remember all the names I'm just yelling or blurting out right now, just go to that link and you'll be able to see all of them there. And you can even sort by if you want specifically US large cap exposure or you want international exposure, you can see the best of the best in each of those categories. So.
Thanks, Brandon. Got a question here from Pam and Frank Turner. Has ESG investing gained a foothold amongst hedge fund investors compared to the universe of ESG-oriented funds? How big is the universe of hedge funds? Brandon, I think that ties into your commentary for private investments. And perhaps you can shed a little bit of light on how hedge funds and larger pools of capital have the ability to influence the operations and the directions of smaller companies that are out there.
Yeah. Yeah, I just took a quick look. It looks like the hedge fund industry as of Q3 2023 was about 5 trillion. That sounds like a lot, but that's actually compared to public markets, not that big, surprisingly. Private investment space has grown tremendously over the years, but is still not as big as public markets for the most part. So ESG investment adoption had started in the private investment space mostly because they have more control over that and they didn't have to answer to the fiduciary question at the same respect that public investment does. Public investing is available to everyone. So it's a little bit harder to get new and innovative investment styles to go through the public investment route. Generally, any kind of new investment approach starts on the private side and makes its way to the public side. In public investments, such as mutual funds and ETFs, USIF says about $1 in $8 are invested in that way. So it's grown tremendously. It was 1 in 9 last year, so it's still growing. And that's a tremendous growth since it was basically non-existent a couple decades ago. It was very niche and really only on the private side. So it's becoming more widely accessible to everyone, and fees are coming down. As Brendan mentioned earlier, the fees have came down tremendously in the public investment side over the last decade, which makes them competitive with a neutral investment strategy. Calvert's kind of been leading the way on that. If it wasn't for Calvert, fee compression would have happened a lot slower. So we appreciate their effort in that space to not only make it more accessible to everyone, even people that are not multimillionaires, but also making it so it doesn't have to cost as much. So we appreciate that.
Brandon, there was another question as it relates to active management in the space. Janine asked, when you talk about quote unquote active managers in ESG, would we take that to mean that even though we'll perhaps pay more, pay higher expense ratios, would we get more strict screening going on or more thorough fundamental analysis versus a passive manager with a lower expense ratio?
Yeah, I would say that's not always the case. I would say historically that makes sense, but not necessarily is the general rule. So there are fund companies that have higher fees just because they don't have scale. That's another really big piece to this puzzle here. So a company like Green Century doesn't have the scale that a Calvert does. So just through the amount of money that Calvert has, they can charge lower fees because they have more money being managed per person than Calvert does, or sorry, than Green Century does. So Green Century has to charge higher fees for the same level of analysis. That's true across the entire investment space, not just ESG. That's why Vanguard can charge such a low expense ratio. They manage a lot of money per person, and they put very little analysis into that compared to an active shop. But I think all of this underpins the idea that ESG in its very nature is somewhat active. ESG investing is deviating from the index. You are overweighting certain companies and underweighting others in an attempt to have more robust screening around values that you care about. We can control that through cross correlations, synthetic diversification, and really complicated analysis tools that we use at Longwave. But it can be that can cost money. That is true. So that's why historically ESG investing has cost more, but not as much anymore that it is growing in scale. The more dollars that go into the ESG space, the more fees have come down. At least that is what is shown. And that same thing has happened in the traditional space. So we expect that to happen in the ESG space. So I would not take it as an overall rule that just because you pay necessarily a higher fee, you're going to get a more socially responsible, a more environmentally robust product. I would say actually they're some of the most cost competitive funds out there do the best, which is kind of interesting. Avantis is a pretty good kind of company that does that. Avantis, 40% of all of their dividends go to a cancer research nonprofit. So when you pay your expense ratio to those funds, which are the lowest in the industry, not only does that fund screen very well, but you know that 40% of the profits that company makes is going directly to cancer research. That's direct impact. That's direct dollars going to something important. So Avantis is one that is not actually on that USIF mutual fund list, so that is one to write down. Avantis does pretty well. They're new. They're very new. That's why you don't see them as much.
Brandon, there was a question that came in. Which firm manages the UU Common Endowment Fund? And I can share some insight here. The Common Endowment Fund, number one, it's managed internally by an investment committee. So there are folks at the UUA who are actively making investment decisions on behalf of the congregations that pool money into the common fund. The actual investing of dollars as to which specific companies the fund allocates to is essentially outsourced. And what we mean by that is that the fund engages and hires third-party asset managers, for example, like a Calvert, like a Boston Trust, like an Avantis, like a Green Century, to do the investing for them. The structure of endowment investing, and Brandon, you're really the expert here, so chime in whenever you have some thoughts. But the structure of endowment investing is the people who are overseeing the fund, they're not stock analysts. They're not picking and choosing stock, which sectors to invest in. Should I go with Amazon tomorrow, or Apple, or Nvidia, or Facebook, or so on? They are hiring investment managers to do that work for them, and they pay a fee for that. There are also consultants that advise on the broader strategy of the endowment, and all of that information is published on the Common Endowment Fund website. There are a few consultants listed, which you can look into, but it's a very layered structure to the actual management. Brandon, chime in if you have some thoughts on how that looks like.
Yeah, the main consultant for the UU is New England Pension Consultants, NEPC. They are the main consultant for the assets at the UU, and they allocate almost all of the capital. So they decide what managers they're going to use in each space. So they need to select a large cap equity manager. They will select that, and then they will select what screens to put on that money. So New England Pension Consultants is the main driving force there, and UU pays a fee to them to basically make all the investment decisions. And they manage a lot of education and faith-based institutional dollars. So the UU is just one of their many, many clients. They're very large. They're one of the largest in the space. They've been doing it for quite a while. So they didn't necessarily always focus on ESG considerations. It seems to be a newer thing for them. So at least from the background research that I've done on them, but the UU seems to be pushing them in that direction. And they do a pretty bespoke job. So given the size of each one of these endowments, the experience each one is going to get is going to be completely customized to the needs of each one. So you're not getting just kind of a cookie cutter in portfolio. So yeah, that's generally how it works.
The last question I saw here, Janine asked, does your company charge a percentage to do management of our portfolios? How do we get paid? Janine, I'll speak just broadly of financial advisors in the industry. The way most advisors get compensated, if they provide comprehensive planning as well as investment management, is through a fee that's charged on the percentage of assets that they manage. The term financial advisor is one that is often used, in my opinion, when it shouldn't be. So you have folks that sell insurance and purely insurance that call themselves financial advisors. You have stockbrokers that call themselves financial advisors. But when it comes down to it, the word financial advisor means all-encompassing financial advice across your investments, your retirement plans, your estate plans, so on and so forth. At Longwave, we follow that model. We're compensated for the advice that we give to our clients, as well as the assets that we manage for our clients. And most of the advisors that are out there in the ESG space, specifically the ones that our network and that we know, they have a very similar structure. Okay. It doesn't look like any other questions have come through the chat box. But again, if any thoughts or questions come to mind, please feel free to reach out. We'd be more than happy to answer them at any time. And Barb, I'll pass it back over to you at this point.
Well, thank you so much, Brennan and Brandon. This has been very informative. Thank you for sharing your expertise and your Sunday afternoon because you're in New York. And if anybody has any questions or interest in this subject, you can get a hold of me through Realm or anyone else in the Environmental Action Team. This is a very hot topic, and there's always more. So thank you, everybody, for taking part, and I hope you have a wonderful, safe, warm afternoon. Keep warm. And Teresa, are you saying something?
Yes, we have one question on here in person. Hang on just a minute.
Oh, contact information for
this
Brennan and Brandon.
right here, which is on. Turning on.
So Longwave Financial.
Are we
you
looking
Google
at
them.
divesting from the Unitarian Universalist Common Endowment and doing our own with other congregations? Or I'm confused a little bit about Lightwave's involvement and what kind of the next steps are, what we're doing, why it's a hot topic.
Well, I meant a hot topic just in general, investing our values. But there's no big plan. I think there was curiosity about how our endowment was being invested, and this is a step in educating ourselves about how our endowment is invested so that we can be aware, consider if this is where the way we want to go. And so the discussion is open to anyone, but this was more of an educational opportunity today, and I'm not sure where the discussion will go from here, but I think you're welcome to participate in the conversation as we go forward. Does that answer your question?
Oh, okay. My name is Diana Finch. Oh, my name is Diana Finch, and I'm just going to stand here and talk. I get too confused. I'm on our Legacy Giving Committee, and I did bring some copies today. The folks who were talking to us have talked a lot about how transparent our CEF website is, and it is very transparent. I've printed a couple of things that we don't have a huge crowd here. I will give it to anyone who would like to have one today. But I think one of the reasons it's a hot topic is because of the GA proposal that went in front of the young people who put something, I don't know quite how to say it, but to divest completely. And there's a board response to that online. It's very easy to access, just UUCEF.org. And press enter, you get a screen, and screen down a little, just scroll down a bit, and you'll start seeing a lot of information. It's almost too much, it's overwhelming to me. But I wanted to let you know I'm happy to help anybody who is trying to find information online about what's going on, and I have things to pass out today to the folks here. Thanks.
Thanks, Diana. And if anyone else has any questions, comments before we close? Well, again, thank you.
We're good here. Thank you.
Okay. Sorry, I didn't mean to ignore the folks who are there in person. I appreciate you staying all this time. And again, Brandon and Brennan, thank you so much for your time today, and we'll look forward to continuing the discussion.
Thank you so much, Barb. Thank you, everybody.
It's always fun to talk about the things we care about. So, thank you.